Welcome to episode 31 of the Ontario Mortgage and Real Estate Insights podcast. I am your host, Steve Hamilton, and today we have some fascinating updates on the housing market that will affect buyers, sellers, and real estate professionals across Ontario and beyond. So let us dive right in. Our first story today revolves around a notable drop in existing home and condominium sales, even as buyers anticipate further interest rate cuts. The Greater Toronto Area saw a significant decline in home sales, with only 6,213 homes sold in June. This marks a 16.4% drop from the 7,429 sales reported in June 2023, according to the Toronto Regional Real Estate Board, or TRREB. Interestingly, new listings have risen to 17,964, which is a 12.3% increase year over year. Despite the increase in listings, the average selling price has dipped slightly to $1,162,167, down by 1.6% from last year. The Toronto Regional Real Estate Board has been vocal about the need for more interest rate cuts from the Bank of Canada. Jennifer Pierce, president of TRREB, mentioned that while the recent rate cut provided some initial relief, it is evident that multiple rate cuts will be necessary before homebuyers feel confident enough to re-enter the market. The Bank of Canada's rate cut last month provided some initial relief for homeowners and home buyers, said Pierce. However, the June sales results suggest that most home buyers will require multiple rate cuts before they move off the sidelines. Jason Mercer, chief market analyst with TRREB, also weighed in, stating that the ample supply of homes should keep prices stable once sales pick up. The Greater Toronto Area housing market is currently well supplied. Recent home buyers have benefited from substantial choice and therefore negotiating power on price, Mercer said. Moving forward, as sales pick up alongside lower borrowing costs, elevated inventory levels will help mitigate against a quick run-up in selling prices. The trend of declining home sales is not limited to Toronto. Calgary experienced a 12.8% drop in home sales in June, compared to the same month in 2023. New listings in Calgary decreased by 3.6% and inventory rose by 9.2%, according to the Calgary Real Estate Board. Condo sales were also down by 8%, with a noted scarcity in properties priced under $300,000. Anne-Marie Lurie, the chief economist of the Calgary Real Estate Board, attributed the decline to a shortage of affordable homes across all residential property types. The pullback in sales reflects supply challenges in the lower price ranges, ultimately limiting sales activity, said Lurie. Despite this, 40% of homes sold in Calgary went for over the asking price, and the unadjusted benchmark home price rose 9% year over year to $608,000. Turning our attention to Vancouver, the city has become a buyer's market as inventory levels have risen to heights not seen since the spring of 2019. The Greater Vancouver Realtors reported that June sales were 2,418, a 19.1% decrease from the 2,988 sales recorded a year earlier. Sales numbers were also 23.6% below the 10-year seasonal average. Andrew Liss, Director of Economics and Data Analytics for the Greater Vancouver Realtors, noted that buyers are hesitant to transact in typical volumes for this time of year, while sellers are eager to list their properties. This dynamic is bringing inventory levels up to a healthy range not seen since before the pandemic. This trend is providing buyers more selection to choose from and driving all market segments toward balanced conditions, said Liss. Like their counterparts in Toronto, Vancouver Realtors are hopeful for another rate cut from the Bank of Canada, which is set to make its next announcement on July 24th. This is yet another factor tilting the market in favor of buyers, even if the boost to affordability is modest, said Liss. But June's lower-than-normal transaction volumes suggest many buyers remain hesitant, which has allowed inventory to accumulate and has kept a lid on upward price pressure across market segments. In contrast to these trends, Montreal saw a bright spot in June, with a 6.4% increase in residential sales in the greater metropolitan area compared to the same month last year, according to the Quebec Professional Association of Real Estate Brokers. Meanwhile, the Royal Bank of Canada issued a report suggesting that while housing affordability still has a long way to go, the market is moving in the right direction. The bank expects a full 2 percentage point cut in the policy rate to 3% by the end of 2025, which should bring down long-term rates as well, albeit to a lesser extent. Our next story focuses on the Toronto condominium rental market, which has seen a significant shift in dynamics during the second quarter of 2024. According to the Toronto Regional Real Estate Board, or TREB, condo apartment listings surged while sales dropped sharply, primarily due to high borrowing costs. This surge in listings has provided renters with more choices and greater negotiating power for lower rents. TREB President Jennifer Pierce highlighted that record population growth has kept the demand for condo rental apartments high during this period. The affordability challenges associated with high mortgage payments for ownership housing also continued to be a driver of rental demand, especially given that we have seen some relief in rents over the past year, Pierce said. Despite the drop in sales, condo apartment rentals increased by 25.2% compared to the second quarter of 2023, with 17,400 rentals reported through TREB's multiple listing service system. However, rental listings spiked by 51.3% year over year. This increased supply of rental units has led to a slight decrease in average rents. One-bedroom condo apartments saw a 3.1% decline in average rent to $2,452, while two-bedroom units experienced a 1.9% decrease to $3,178. Jason Mercer, chief market analyst at TREB, cautioned that this rental relief might be temporary. While the increase in available inventory over the past year has resulted in slightly more affordable rents, it is important to understand that this relief could be short-lived if we do not see a steady stream of new rental units coming online, both in terms of purpose-built rental and investor-owned condo rental units, Mercer said in the report. The average condo apartment selling price in the second quarter of 2024 was $729,005, down 1.2% from $737,925 in the second quarter of 2023. In the city of Toronto, the average selling price decreased by 0.5% to $765,963. Mercer noted that despite the increased supply, prices have remained relatively stable. This suggests that sellers are holding relatively firm on their listing prices, he said. This may be in anticipation of improved market conditions as borrowing costs continue to trend lower this year and next. Jennifer Pierce expects the market to improve as affordability increases. The condo market is very sensitive to interest rates, given that this segment is a traditional entry point into home ownership, Pierce added. With monthly payments remaining high and average rents edging lower over the past year, many would-be buyers remain on the sidelines. However, over the next year, an improving affordability picture will see a growing number of first-time buyers enter the condo market. Let us now turn our attention to the recent report from the Bank of Montreal, which indicates that while Canadian mortgage arrears have been rising, they are not expected to reach their long-term average. Despite a gradual increase, the arrears rate remains historically low. As of April, the rate fell to 0.18% from 0.19% in March, where it had held steady for 3 months. This translates to just 9,252 mortgages in arrears out of over 5.02 million, according to the Canadian Bankers Association. The national arrears rate has risen from a low of 0.14% in 2022, but remains below its recent peak of 0.27% reached in June 2020 and significantly lower than the all-time high of 1.03% in 1983. However, not all regions of Canada are experiencing the same trends. Saskatchewan, for instance, has a significantly higher arrears rate, hovering near the 0.60% mark for the past 4 months. On the other hand, Ontario boasts the country's lowest delinquency rate at 0.13%, followed by British Columbia at 0.16%. BMO senior economist Sal Guadieri noted that this is the first time since the financial crisis that home loan defaults in Canada are mounting, driven by rising joblessness, resetting mortgages, and soft home prices. He questioned how much higher these arrears could go. According to Guatieri, the vast majority of Canadian mortgage holders have continued to make their mortgage payments. even if it meant reducing discretionary spending or negotiating longer amortization periods with their lenders to lower monthly payments. This has helped stabilize aggregate mortgage service costs as a share of income, albeit near record highs. Despite recent easing from the Bank of Canada and a decline in fixed-rate mortgages, a still rising unemployment rate is expected to drive delinquencies higher in the near term. In June, the national unemployment rate rose by 2 percentage points to 6.4%, translating into a total of 1.4 million unemployed individuals. According to projections by Oxford Economics, the unemployment rate could top out at 7.5% by the end of the year, though BMO sees it peaking at around 7%. Guattieri pointed out that with the rise in unemployment and mortgage resets, we should expect some upward drift in arrears. A record number of mortgage renewals at significantly higher rates in the coming years is also expected to pose a challenge for many borrowers. According to the Bank of Canada, the median payment on a maturing loan could rise by 34% by the end of 2027. For some borrowers, payments will modestly exceed stress-tested levels, while others will benefit from fixed rates that are now less than the qualifying rate, which for many was 5.25%. The mortgage stress test, which ensures that borrowers can manage payments even if rates rise, requires qualifying at the higher of the minimum qualifying rate, currently 5.25%, or their contracted mortgage rate plus 2%. This measure helps prevent defaults by ensuring borrowers have a financial cushion. Even with a sustained rise in the arrears rate from current levels, it would take significant momentum to approach the long-term average rate of 0.40%. BMO forecasts mortgage arrears to peak at 0.34% by mid-2025, before settling back at 0.28% in the medium term. If it were not for income support programs, aggressive rate cuts, and the rapid economic recovery, Canada's arrears rate would have been significantly higher due to the pandemic-driven spike in the unemployment rate, which reached 13.7% in May 2020, the highest rate recorded since comparable data became available in 1976. The resilience of the Canadian housing market has also contributed positively. Home prices have remained robust, providing homeowners with equity that can be leveraged if necessary, thus acting as a safeguard against a significant rise in arrears. However, BMO acknowledges there are upside risks to its forecasts. For instance, a rise to 9% in the national unemployment rate due to a weaker economy would cause the arrears rate to modestly surpass its long-run mean. Additionally, if home prices were to fall another 14%, the arrears rate would peak just below the long-run mean. But the more likely scenario, according to BMO, is that falling interest rates will support a modest recovery in the economy and house prices, thereby limiting the strain of mortgage resets. Guattieri concluded that the mortgage stress test, introduced in 2016, should pass its first big test. Our final story today dives into the topic of home equity, specifically when and how to tap into it. With Canada's housing market seeing significant appreciation over the last few years, many homeowners are sitting on substantial equity. According to the Canadian Real Estate Association, the average home price in Canada was $733,300 in May 2024, nearly 40% higher than 5 years ago. This surge has resulted in Canadians accumulating an astounding $4.7 trillion in home equity. Given the rising cost of living due to inflation, some Canadians might look to their home's growing value to cover expenses or consolidate high-interest debt. One of the most common ways to turn equity into cash is by taking out a home equity line of credit, or HELOC. While some Canadian banks offer lump-sum home equity loans, HELOCs tend to be more popular. However, the landscape for HELOCs has changed recently due to new government regulations. Carla Gervais, Director of Sales and Operations and Principal Broker for the Mortgage Advisors in Ottawa, highlights that getting a HELOC is a bit harder now after the government introduced new rules in late 2023. The Office of the Superintendent of Financial Institutions, or OSFI, imposed a new rule that a HELOC credit line cannot exceed 65% of a home's current loan-to-value ratio. Previously, homeowners could borrow up to 80% of their home's loan-to-value ratio. This adjustment aims to ensure borrowers can better manage their debts and reduce the lending risk for regulated banks. Richard Sklar of David Sklar and Associates, a licensed insolvency trustee firm in Ontario, explained the reasoning behind this change. He noted that the Canadian housing market is vulnerable due to stubbornly high home prices and steep interest rates. A wave of defaults on HELOCs and mortgages could devastate the economy, which the OFSI wants to prevent. So, when does it make sense to tap into your home equity? An attractive benefit of HELOCs is that you can use the money however you wish. But a good rule of thumb is to borrow equity only when it can save you money or increase the value of your home over the long term. Common examples include paying off credit card debt or financing major home improvements. However, with today's higher interest rates, fewer people are rushing to get a HELOC. Carla Gervais points out that with many mortgage renewals coming up that were taken out when rates were at pandemic-era lows, homeowners will feel the sting of renewing at today's higher rates. She mentions that some homeowners might prefer to do a blend and extend with their rates over getting a HELOC, as it might offer better terms. This means they take the current rate and a larger loan balance when they restart their loan clock, instead of opting for a HELOC with an even higher and more unpredictable variable rate. Gervais emphasizes that the decision to tap into home equity should be strategic. It depends on when you need the funds, if you can pay it off quickly, and what you intend to use it for. Homeowners should also be mindful to avoid a debt spiral by negotiating with their lender for a lower rate, paying down the balance quickly, strengthening their credit score, and considering paying down more of the mortgage balance to increase home equity. To qualify for a HELOC, you will need a minimum credit score of 650, although this can vary by lender. Your debt-to-income ratio also plays a crucial role. For HELOCs, with a lower credit score, the maximum debt-to-income ratio is 35% for housing payments alone and up to 42% for all monthly debts. For borrowers with higher credit scores, the maximum debt-to-income ratio is 39% for housing payments and no more than 44% for all debts. Additionally, the qualifying benchmark rate for a HELOC is either 5.25% or your lender's rate plus 2%, whichever is higher. With the prime rate at 6.95% and HELOCs at prime plus a half, you are looking at a 7.45% rate and qualifying at 9.45%. Employment stability is also essential. If you are in a full-time salaried role, you do not necessarily have to be at a company for 2 years. You could qualify if you have been there for 6 months. For self-employed individuals, lenders will look at average earnings over 2 years. Gervais advises homeowners to be mindful about tapping into equity. You'd want to use it smartly, and you want to make sure that it's comfortable for your budget so that you can maintain it, she says. You don't want to be house poor. That wraps up our episode for today. Thank you for joining me on the Ontario Mortgage and Real Estate Insights podcast. Stay tuned for more updates and insights on the housing market. Until next time, I am Steve Hamoan, wishing you a fantastic day and successful real estate ventures.